Hello and welcome to Banks and Markets. This is Binam, and in this video I will be talking about portfolio performance evaluation. In fact, I'm going to show you simple Excel tools, how we can apply them to evaluate the performance of a fund. So basically I have this example here. This example in fact talks about the return enjoyed by a fund. This fund, this data is the real world data, and it was given to me by my PhD supervisor, Professor Christian Dunis, who unfortunately passed away. Christian Dunis. So this oh, we can't find his image. Maybe if I type in professor, then oh, Christian is not typed in correctly. Okay, yeah. Okay, so he used to be my PhD supervisor, one of my PhD supervisors. Okay, and he very kindly gave me this data, and then I thought, how can I make it useful for my students? And we really do not want to think a lot in terms of formulas, so let us see how, using the simple Excel based tools, we can talk about this particular fund's performance. So you can see that I've got data for 216 different months, all the way from January 1992. So what I'm interested to find out is different portfolio statistics, and using those statistics I will be able to evaluate the fund's performance. So first thing is, what is the annualized return given these are monthly returns? So the annualized return is equal average of all of these. Yeah, so if I do this, what I get is the monthly average. Now in order to make it annual, what I need to do is simply equal 1 plus this rate of return, which is R, which is monthly. Therefore now 12 take away 1, so that way I will be able to analyze this monthly return. So I get 12.86. Now the second indicator is called cumulative return. Now what we can do to find out the cumulative return is simply start adding them. So this is 1.2, remains the same, but from this point onwards we add, and therefore we start accumulating, and in the end what we get, 218.85%, is in fact the cumulative return. But you can simply say sum of all the monthly returns to get the same 218.85. okay, so that's cumulative return. But one usefulness of finding out the cumulated profit for each period is the fact that we can obtain an equity curve, and it's a very nice concept, very simple but nice. This shows the performance actually, and if it is a upward rising curve, then that basically means the fund performance is good. Can you see? So the fund in which certain strategy were implemented by Professor Christian Dionys has performed good, as shown by this equity curve. Of course there are some fluctuations, but overall it's a smooth upward rising trend. So that's called equity curve actually, or if they were that is based on stocks equity curve, but upward rising is what we wanted to see. Then it is asking you annualized volatility, which is annualized standard deviation. So we can simply say equal STDEV, and therefore now we can say what is the standard deviation, and we can find this one out by taking these numbers from here all the way here. Now this is going to give us monthly standard deviation, which is 3.10%, but we aim to analyze it. This then basically means times, we need to times square root, these are monthly, so 12. So therefore we get 10.75. Now the Sharpe ratio is simple. Sharpe ratio is basically the excess return, and in the absence of risk-free rate we can simply say 0, or even not mention it, and divide it by the annualized volatility. That is going to give us Sharpe ratio 1.2. 1.2 Sharpe is what we obtained. So that is the Sharpe ratio generated by this fund. Now what is maximum monthly profit? So we want to think in terms of the dispersion of the return data. So equal max is what you can do to find out monthly return maximum, and therefore you now have 9.95% in one particular month. The highest that was recorded is 9.95. Now what is the minimum and that was earned? So can be some negative value, which is minus 6.38%. That's fine. Now there is another called maximum drawdown. Let me calculate it later. Now what I have next is percentage winning trades. Percentage winning trades. Now this is something I can find out by finding first how many winning trades do I have here. So you win a trade if your return is greater than 0, isn't it? So what you can say is if equal if this monthly return here is greater than 0, then say 1, otherwise say 0. Okay, so that's what you can do. So here 1.2 is higher than 0, so it should give me 1, and therefore this is correct. Now I can drag it down for all my remaining cells, so copy it and paste it in all the cells. So now I have it for all the 216 months. Now the question, however, is in this 216 months, how many times have I won? So that's the percentage winning trade. So what we can do is therefore first find out the total number of winning trades. So basically you can sum these up together and you get 122. and you know there are 216 of them. So 216, 122 out of 216. So you can do this to find out the percentage winning trade, which is 56%. But again, let's make our life simple, which is if you just do the average for the winning trades, that 56% is what you will achieve just by doing this. Okay, that's 56%. Now percentage losing trades is very simple, equal 1 minus the 56%. So that's how you get 43.52%. Now number of up periods. Okay, now this is also simple, but it is just to tell you how many times there were periods in which there were returns greater than 0. So you already know it is 122, but what you can do in Excel is say to Excel equal count if in this range of monthly returns, if there are returns greater than 0, so greater than symbol 0 and inverted comma again, close the bracket. So that's going to give you 122. How we did? Again, and this is what we did. Count if the range comma inverted comma greater than 0. Now number of down periods, of course it's 216 minus 122, but you may as well like to do copy this, paste it here, so you get exactly the same. Then now instead of greater than 0, make it less than 0, so you get that 94. So of course 194 add 122 will give you 216. So that's correct. Now average gain in up period, you see, it's very simple, but the portfolio manager, what is the average gain when the market is bullish? What is the average gain when the market is bearish? This is what we can find out using these two indicators. So simple but interesting. So what you do therefore is average gain in up period. To find that out, you can use sum if function, sum if, and this requires you to take the range and then put greater than 0 inside the inverted, and you need to define the range again in the sum if function. So therefore you get, this time you get this number here, but it's not complete yet. Okay, sum if all this, but then here average gain is what we're talking about. This is the total of all the gains when this is greater than 0. We need to divide it by this number of up periods, and therefore we get average gain in up period now, which is 3.12%. So monthly average gain in up period 3.12% is what we found. Now I'm going to find average loss in down periods. To do that, and just to make my life easy, I'm just going to copy it and then paste it here, so it's exactly the same. Now what I will do, instead of greater than sign, I will change the sign to less than. Remember, this is not correct yet because it's not C12 but C13, which is number of down periods. Now therefore I've got minus 1.72. The beauty of finding these two is the fact that now we can find out average gain loss ratio, and therefore the average gain loss ratio is this divided by this number here. Now generally average gain loss ratio is not reported in negative terms, so what we can do therefore is we can say ABS for C15. So therefore average gain and loss is 1.81. C, we found a number of indicators, and the one that is remaining is maximum drawdown. You may now like to know what a maximum drawdown is in terms of concept. Okay, so basically maximum drawdown is an indicator of the risk of a portfolio chosen based on a certain strategy. It measures the largest single drop from peak to bottom in the value of a portfolio before a new peak is achieved. I would like to repeat this again. Basically, maximum drawdown measures the largest single drop from peak to bottom in the value of a portfolio before a new peak is achieved. So I will now illustrate this. In order to find out the maximum drawdown, what you can do in this example is first find out the drawdown for each individual month. And to do that, I suggest what you do is apply this, which is equal this cumulated profit minus max, open bracket, go back to the same which is here, okay, and then you can lock it, and semicolon, you can lock it later. Okay, so you do this and you lock D20, the first one, and you get this. Okay, so this is what you have done. Cumulated profit minus maximum of the range that we want to establish is starting from the first month, which is D20. So if you scroll it down now, you see you get 0 again. Okay, you get 0 again. If you scroll it down here, conceptually you should not get the 0, because the method basically means the largest single drop from peak to bottom in the value of a portfolio before a new peak is achieved. So therefore now you get minus 1.77. okay, this is rising, no problem. Now that this has fallen down 3.46, 1.7 is less. So the drawdown is basically has taken the single drop from peak to bottom in the value of the portfolio before a new peak is achieved. Okay, so now there will be 0 again there will be 0, but this time you see the value drops, therefore before a new peak is achieved, therefore you get this and 0 again. So this then basically means I can simply copy this all the way down, and I have just done that. Now these are the drawdowns. In order to find out the maximum drawdown, I need to find out, because this is drawdown, I need to find out the minimum value. So equal minimum of all these drawdowns. Okay, so I get minus 17.02, which seems a bit higher. So now we may like to report how good, bad the performance has remained. Of course, we don't have any benchmark to compare here, therefore it is not going to be the best evaluation. But what we can still say is something like over the entire period, the Sharpe ratio and percentage winning trades are good, and the Sharpe ratio is 1.2, percentage winning trade is again attractive 56% because it's higher, of definitely higher than 50%. So you have won in a way. So that's what we can say, that they're good. And what it basically means is this shows a fine risk adjusted performance. Okay, that's what you can say. Of course, the average gain and loss ratio, which was 1.82, is also quite good. Can you see here? Average gain and loss ratio we found is 1.81, so that's good. Gain loss 1.81 times, so that's interesting there. Okay, but we saw that the maximum drawdown is a bit high. Yeah, so we can say that the maximum drawdown is slightly high at 17 something we found. Yeah, 17, isn't it? What is it? 17.02 negative is what we can mention here, minus 17.02. But we may like to see why this has happened this way, and what I know, because I have observed this data, is there are some periods in which the drawdowns are substantially higher. They were the periods after 2000. So after 2000, if you see the drawdowns, see in even 1999 actually, they are picking a lot from this point, May 1998, 9.87 and so on. But after certain time, so this is the time, 98 to 2000, really high. Just these 25 months between the period February 98 till the period ending in fact 9.74 is where we can stop here. Yeah, October, until October 99. But after that it's really low. So maybe those period definitely those period affected the maximum drawdown a lot. Okay, so in this video I just made an attempt to tell you how Excel can be used to evaluate your portfolio's performance. Of course, there are so many other tools that can be incorporated, and I'll be providing another comprehensive example to illustrate several other portfolio performance measurement technique to evaluate portfolio performance against the benchmark. But thank you very much for listening. Thank you.